February 5th, 2026, $10 billion traded through BlackRock's iShares Bitcoin Trust in a single day, the highest single-day volume in the fund's history. Not a week, not a month, one day. But before I show you what that means, let me show you something even stranger. Look at these 3 weekly candles. 3 weeks, 3 completely different stories, but one of them doesn't make sense. Week 1, large red candle, price drops significantly. Volume, small, barely visible. Week 2, another red candle, price continues dropping. Volume, still small, minimal resistance. Week 3, February 5th week, small-bodied candle with a long lower wick. Volume, absolutely massive, the biggest bar you see on the entire chart. Now let me ask you something that should bother you. Why did price drop easily for 2 weeks with almost no volume, then suddenly encounter massive volume only when it hit a specific level? Think about it. If Bitcoin was in a real collapse, wouldn't you expect high volume during the entire fall? But that's not what happened. Price dropped like a stone through air for 2 weeks. No resistance, no volume. No one cared. Then, at a very specific price level, a level that had been tested and defended multiple times in the past, suddenly $10 billion shows up in one day. Someone was waiting. And I'm going to show you exactly what they were waiting for. But first, let me show you what happened on February 5th. $370 million fled BlackRock's fund. Outflows, investors redeeming in panic, 7,925 Bitcoin dumped by ETFs, forced selling to meet redemptions. Options trading exploded, 2.33 million contracts. $900 million in premiums, both records. Hedge funds getting margin called. Institutional chaos. So here's the question. If ETFs were dumping 7,925 Bitcoin, if $370 million was fleeing, if the biggest volume in history happened during forced selling, who was buying? Because someone was. And they only showed up on week 3, not week 1, not week 2, week 3, at a very specific price. Now let me ask you 5 questions, because these 3 candles reveal something most traders will never see. Question 1, why is the volume massively disproportionate to the candle size? Look at the 3 weeks. Week 1, large red candle moving price significantly. Volume bar, tiny. Week 2, another large red drop. Volume, still tiny. Week 3, small-bodied candle with a wick. Volume bar, 5 to 10 times larger than the previous 2 weeks combined. The candle that moved price the least has the volume that's the largest. That's backwards. Unless someone was absorbing. Unless institutions were buying everything, retail was panic selling without letting price move down further. That's not a crash. That's accumulation disguised as a crash. Question 2. Why did price fall without resistance for 2 straight weeks? In a real panic, you'd expect volume throughout the entire decline. Buyers and sellers fighting at every level. But weeks 1 and 2, price just fell. Easily, smoothly, like someone removed all the buy orders and let it drop. Why? Because the real buyers were waiting at a specific level below. They pulled their bids, let price come to them, then stepped in with size on week 3. Question 3. Why did massive volume only appear at a price level that had been defended multiple times before? The level where week 3 found volume is not random. Go back on the chart. August 2024. This exact price zone held. Even earlier in 2023. It's a consolidation level, a decision point, a zone where price has proven it can find support. Institutions don't buy random levels. They buy levels with history, levels that have shown they matter. Question 4. Why did this exact 3-week pattern happen in August 2024? Look at the chart. August 5th, 2024. Same structure. Price dropped on low volume for multiple weeks. Then massive volume spike at a historic support level. Long wick showing absorption. Immediate recovery and rally. It's not the first time this happened. It's a playbook being run twice. Same setup, same execution, different date. Question 5. If this pattern appeared in August 2024 and again in February 2026, and you didn't recognize it either time, what does that tell you? You check price constantly, you read headlines, you watch Twitter panic in real time, but you missed the volume story. You missed the 2-week setup. You missed the absorption at historic support. Twice. Why? Because you've been taught to watch price movement, not institutional footprints. And that's what this video is about. Teaching you to read volume like the institutions who were waiting for February 5th, not to predict the future, but to understand what just happened, using a methodology developed over 100 years ago. Richard D. Wyckoff, early 1900s, former stock trader and editor of Magazine of Wall Street, studied how large operators, what he called the composite man, accumulated and distributed stock, developed the Wyckoff method, the foundation of reading institutional footprints. Tom Williams, 1960s through 2000s, former syndicate trader, spent decades inside the institutional world moving markets, took Wyckoff's principles and codified them into volume spread analysis, wrote Master the Markets, The Bible of Reading Effort versus Result, Anna Culling, 2010s, modern trader and educator, took Wyckoff and Williams's institutional knowledge and translated it for individual traders, wrote A Complete Guide to Volume Price Analysis, made VSA accessible, the bridge between institutions and retail, 3 generations. Same core insight. Volume tells you what institutions are doing. Price tells you what retail thinks is happening. Now let me teach you their framework. This video is educational analysis, not financial advice. Do your own research. Consult professionals. Never invest more than you can afford to lose. The creator is not a certified financial advisor. Over the next 30 minutes, I'm going to teach you a volume spread analysis through the lens of these 3 weeks. You'll learn the 3 core elements: spread, volume, result. How to identify stopping volume, why volume disproportionate to candle size reveals absorption, why price falling without resistance is a setup, not a crash, how to think in probabilities, not certainties. And by the end, you'll understand what happened on February 5th, who was buying, why they waited for week 3, and how to recognize it next time. If you've never noticed that volume and candle size don't match, comment disproportionate volume. If you're wondering why price dropped without resistance for 2 weeks, comment where were the buyers? Hit that like button. Subscribe, because what comes next will change how you see charts forever. Volume spread analysis is built on one principle that Richard Wyckoff discovered over 100 years ago. Markets are controlled by what he called the composite man, large institutional operators, not by chaos, not by chance, by design. Wyckoff said, the composite man carefully plans, executes, and concludes his campaigns. Translation, institutions don't react, they plan. They wait, they execute, and they leave footprints in volume. Tom Williams, who actually worked inside syndicates moving markets, refined this into a formula: effort versus result. Anna Culling made it accessible. Volume validates price movement. Without volume, there's no conviction. VSA analyzes 3 elements: spread, volume, result. Element 1, spread, the range of the candle. High minus low, wide spread equals strong movement, narrow spread equals weak movement. But here's what Wyckoff taught. Spread alone is meaningless. You must compare it to volume. A wide spread on low volume, weak move, no conviction. A narrow spread on high volume, absorption. Someone is buying or selling aggressively but not letting price move. Look at our 3 weeks. Week 1, wide spread, low volume. Week 2, wide spread, low volume. Week 3, narrow body with wick, massive volume. That's absorption. Element 2, volume, the amount of activity. But volume is meaningless without comparison. Tom Williams' formula. Compare current volume to the recent average. 1 to 1.5 times equals normal. 1.5 to 3 times equals elevated. 3 plus times equals anomaly. Institutions are active. Our 3 weeks, weeks 1 and 2, had below average volume. Week 3 had volume 5 to 10 times higher than the previous weeks. Massive anomaly. Element 3, result. Where did price close relative to the range? Upper third? Buyers 1, middle third? Neutral? Lower third? Sellers 1, plus the wicks. This is critical. Tom Williams said, wicks show you where the real battle happened. Week 3, small body, long lower wick. Price tried to go down, failed, recovered. That wick is proof of buying. Now combine all 3. Effort versus result. Effort equals volume. Result equals price movement. The VSA revelation: when effort and result don't match, institutions are active. Pattern 1, high effort, low result. Massive volume, but price barely moves. Someone is absorbing. Week 3 is this pattern. 10 billion in volume, small candle body, long wick showing rejection of lows. Pattern 2, low effort, high result. Low volume, big price move, no resistance, easy movement. Weeks 1 and 2 are this pattern. Large price drops, minimal volume. No one was defending those levels. Why? Because the real buyers were waiting lower, at the level they wanted. Anna Culling calls this the no-demand drop. Price falls not because of heavy selling, but because of absent buying. Institutions remove their bids, let price fall to their desired level, then step in with size. That's what happened here. 2 weeks of no demand. Then week 3, stopping volume. Location is everything. Wyckoff taught, determine where you are in the market cycle. Where did week 3 find volume? At a price level that had been tested and defended multiple times. August 2024, earlier periods. It's not random. It's a known support level, a previous consolidation zone. Institutions don't buy random levels. They buy levels with history, levels where price has shown it can hold. CTA number 2, if you just realized that weeks 1 and 2 were a setup, not a crash, comment, no demand drop. If you understand why volume appeared only at the historic level, comment, Wyckoff was right. Like if this is making sense. Because next, I'm showing you how two traders saw these 3 weeks completely differently. Marcus and Victoria are fictional characters, representing common retail versus institutional behaviors. They are educational constructs, not real people. Let me show you how two traders interpreted these exact 3 weeks. Marcus, retail trader, 18 months experience. Victoria, institutional portfolio manager, 15 years using VSA. Week 1 of the drop, price falling. Marcus sees large red candle, checks Twitter. Everyone saying, correction healthy, still bullish long term. Marcus holds, no concern yet. Victoria sees large red candle on low volume. Notes, no demand. Price dropping without resistance. This is a setup, not distribution. Someone is removing bids to let price fall to their level. Watch for stopping volume at next major support. Week 2. Price continues dropping. Marcus, now worried. Portfolio down 15%. Checks Reddit. Post saying, sell before 50,000. This is the real crash. Marcus is panicking but hasn't sold yet. Hands shaking. Victoria sees second week of dropping price, still low volume. Notes, continuation of no demand pattern. Price has now reached the August 2024 support level. High probability stopping volume appears this week or next. Prepare capital for deployment. Week 3, February 5th, the crash day. Marcus wakes up to phone exploding. Bitcoin down to 60s, his portfolio crushed. Opens Twitter, pure panic. Sell now, going to 40,000. Reddit melting down, everyone capitulating. Marcus sees the massive red volume bar forming, thinks, this is it. Everyone's selling. I need to get out before zero. Sells everything. Lock in the loss. Better safe than sorry. Victoria wakes up, checks charts, sees exactly what she expected. Massive volume spike, long lower wick forming, price at historic support level, runs her VSA analysis, spread, narrow body despite the wick. Volume, 10 times previous weeks, disproportionate to candle size. Result, price rejected lows, long wick. Location, exact support from August 2024. Checks institutional data, BlackRock IBIT outflows 370 million. ETFs dumping 7,925 Bitcoin. Options premiums, 900 million. Victoria to team, this is it. Classic stopping volume after a no demand drop. 3 week setup complete. Retail is capitulating. We're the buyers. Deploy 85 million, scale from 68 to 70,000. The difference in what they saw, Marcus saw 3 weeks of falling price. Week 3 looked like the worst because of the volume spike. Selling into strength. Getting out. Victoria saw 3 week accumulation setup. Weeks 1 and 2. No demand drop to bring price to desired level. Week 3, stopping volume absorption at historic support. Buying retail's panic. Same 3 weeks. Opposite interpretation. Opposite action. Now let me show you this exact pattern happening before. August 5th, 2024. The first pattern. Look at the chart. August 2024. Similar 3 week structure. Price dropped into support. Minimal volume during the drop, then massive volume spike at the bottom. Long wick, immediate recovery. What happened next? Bitcoin rallied from that August low through the rest of 2024 into 2025 highs. Marcus, in August 2024, didn't recognize the pattern. Either sold the bottom or wasn't positioned to buy. Victoria, in August 2024, saw the same VSA setup, bought the stopping volume, rode the rally. February 2026, the pattern repeats, same structure. No demand drop for 2 weeks, stopping volume at historic support on week 3, long wick showing absorption. Marcus sold week 3, third major mistake, sold the exact bottom. Again, Victoria bought week 3, second time executing the same playbook, bought institutional absorption. Again, 1 month later, March 2026, Bitcoin, $82,000. Marcus, cumulative results. Multiple losses across multiple patterns. Total down approximately $20,000 plus opportunity costs. Deleted trading apps. Blames manipulation. Victoria. Cumulative results. 2 successful accumulation trades. August 2024 entry plus February 2026 entry. Combined gains over $100 million on deployed capital. March 9th, 2026. 1 month after the 3 week pattern completed. Bitcoin, $82,000. Marcus. Total losses across multiple patterns over the past year. Minus $20,000 plus massive opportunity costs from missing rallies. Deleted all trading apps. posts on Reddit about market manipulation, blames institutions for rigging the game, chose victimhood over education. Victoria. Total gains across 2 pattern executions, approximately plus $100 million on deployed capital from August 2024 and February 2026. Accumulation zones. Currently, scaling out portions at 82,000 as planned. Stops moved to protect remaining position. Executing her system methodically. No emotion, no panic, just process. The fundamental difference. Marcus sees 3 red weeks and interprets it as a crash. He sees massive volume and thinks everyone is selling. He reacts with fear. Victoria sees a 3-week accumulation setup. She sees no demand drop, followed by stopping volume at historic support. She executes with discipline. Same charts, different education, different framework, different results. The critical question, which one are you? Not who you want to be, not who you think you are, who you actually are based on your behavior. Most of you watching this are Marcus. That's not an insult. That's statistical reality. 95% of retail traders lose money precisely because they react like Marcus. But here's the truth. You don't have to stay Marcus. You can learn VSA. You can study Wyckoff, Williams, and Culling. You can build a systematic approach. You can learn to read volume instead of just reacting to price. It takes time. It takes discipline. It takes humility to admit you've been doing it wrong. But it's possible. Critical reminder, this video is educational analysis, not financial advice. March 9th, 2026, 1 month after the 3-week pattern completed. Bitcoin, $82,000. Marcus, total losses across multiple patterns over the past year. Minus $20,000, plus massive opportunity costs from missing rallies. Deleted all trading apps. Posts on Reddit about market manipulation. Blames institutions for rigging the game. Chose victimhood over education. Victoria. Total gains across 2 pattern executions. Approximately plus $100 million on deployed capital from August 2024 and February 2026. Accumulation zones. Currently, scaling out portions at 82,000 as planned. Stops moved to protect remaining position. Executing her system methodically. No emotion. No panic, just process. The fundamental difference, Marcus sees 3 red weeks and interprets it as a crash. He sees massive volume and thinks everyone is selling. He reacts with fear. Victoria sees a 3-week accumulation setup. She sees no demand drop, followed by stopping volume at historic support. She executes with discipline. Same charts, different education, different framework, different results. The critical question, which one are you? Not who you want to be, not who you think you are. Who you actually are based on your behavior. Most of you watching this are Marcus. That's not an insult. That's statistical reality. 95% of retail traders lose money precisely because they react like Marcus. But here's the truth. You don't have to stay Marcus. You can learn VSA. You can study Wyckoff, Williams, and Culling. You can build a systematic approach. You can learn to read volume instead of just reacting to price. It takes time. It takes discipline. It takes humility to admit you've been doing it wrong. But it's possible. Critical reminder, this video is educational analysis, not financial advice. Do not buy Bitcoin because of this video. Do not sell Bitcoin because of this video. Do not make any financial decisions based solely on this content. Do learn the analytical framework. Do conduct your own research. Do understand your personal risk tolerance. Do consult qualified financial professionals. Do manage risk appropriately. The creator of this content is not a certified financial advisor. The creator does not know your financial situation. The creator cannot be held responsible for your investment decisions. Never invest more than you can afford to lose. Never use leverage you don't understand. Always have a plan for both success and failure scenarios. Trade and invest responsibly. If this video changed how you think about volume and price, do 3 things. 1. Hit that like button. This video took over 40 hours to research, verify sources, and create. 2. Subscribe and turn on notifications. Next video. Advanced VSA patterns institutions use that retail never sees. 3. Comment honestly. Tell me where you are. Comment I was Marcus if this opened your eyes to how you've been trading. Comment learning VSA if you're committed to studying this methodology. Comment 3-week setup. If you finally see how the pattern works, the next accumulation pattern will appear, maybe next month, maybe next year, maybe in a different market entirely. The question is, will you recognize it, or will you be Marcus again, selling the bottom while institutions accumulate? The choice is yours. Markets don't transfer wealth randomly. They transfer wealth systematically, from the emotional to the disciplined, from those who see 3 red weeks as a crash to those who see it as a setup, from those who react to price to those who analyze volume. Which side will you be on next time?